battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office for the past 45 years now. It's been the Stenger family's mission to deliver clarity and confidence to you to help secure your financial future. Thank you for coming back for episode 212. And yes, we did take a couple week break here. We had a couple weeks of traveling to see clients and getting everybody up to speed on their financial plans for the new year. So unfortunately, I had to take a few weeks off, but we are back. Let not your heart be troubled. I did want to address some of the volatility that we're seeing in the market the past week or so. And I do have some slides to share with you today. And one of the things that you may also be wondering is, Nick, where is the studio? We are actually renovating the old podcast studio and moving a few things around here. So should be back in the studio here any week now. So that's exciting. And the other thing I'll just mention before we jump into this week's content is October 8th and 9th is Investor Day. And many of you have already blocked that on the calendar, but don't forget to block this off on the calendar. We keep having more and more people sign up for the pre-registration list that's already active. So I'm going to pause for a second, open up your phone if you're watching at home, or open up your computer. What I want you to do is go to October 8th and 9th in 2026, later this fall, and just block off those dates now so that you have them on the calendar. You cannot miss this year's Investor Day, featuring the legendary Tom Lee, former head of research from JP Morgan, absolutely incredible. And he's going to tell you what's going on as well with technology, with all the things that we're seeing in the stock market today. So don't miss that, October 8th and 9th, later this year. And it's going to be the same place at Gibson's in Oak Brook. All right, let's jump into it, episode 212, and this is called Fire Sale. I do think many stocks are on sale. I think actually the general market's on sale, and I want to show that to you in the next couple of slides. But what I always like to do, and we've talked about this consistently in the past, is in the stock market, when in doubt, zoom out. So if all you do is track these one-day moves on the stock market, 1 month moves, 1 week moves, anything like that, you're going to see a chart that looks very similar to what you're seeing on your screen. This is the 1 month chart of the S&P 500. And you may say, Nick, wow, stocks are down. And you said stocks were going to go up over the long run. You're wrong, clearly, because the stock market's down temporarily. And what I always want to remind you is, when in doubt, zoom out. And so even if we just go out 1 year now, the past 12 months, here's a chart on the S&P 500, and look at the reality of where the stock market is today. We bounced off that big drop in April of 2025. If you can believe it, Liberation Day was almost a year ago now, in April of 2025, and that was a scary time. S&P was down 19%, but still, even with that correction, we're still year over year up on the S&P about 12%. And so you look at these moves in the short run, and if all you do is focus on these moves, you're going to miss the big picture. You're going to miss the long run trajectory of the stock market. And so for the past 2 years now, 3 years, 5 years, certainly 10, 15 years, the market is up. And that's because entrepreneurs are innovating, creating value, and that's driving up earnings. So we go through these different corrections and pullbacks in the market from time to time. Don't be alarmed by them. We're about 2.5% lower off the record all-time high of the S&P, which barely just touched 7,000 points, which is a historic number in the S&P. Never been at 7,000 before until just recently for a brief second. And now we're correcting off of that. So we're back to the 6,850 level on the S&P. Don't be surprised by this. I mean, what in the world would we be doing if we were nervous about the fact that the S&P is at 6,800 points? A year ago, the S&P was just barely over 6,000 points. And so put things in perspective, look at the long run trajectory. When we hit 4,000 points, people said the market was overvalued and we were going to come crashing down. 5,000, everybody said the market was overvalued. 6,000 people said the market was overvalued. This is nothing new. We've been through this time and time again, where the doom and gloomers, the bears who have missed out on the bull market run of the past 10 or 15 years, finally come out of the woodwork and tell you why this time's different. And I believe what they do is they're just jealous, quite frankly, of the people who are bullish bullish, the people who actually made money the past 10, 15 years. A lot of these bears have just been calling for doom and gloom each and every year since '08 and '09. And every year with the new year, this is the one. This is going to be it. This is going to be the year that takes us down. And this is the year that we're going back to '08 and '09. They've been saying that for 15 years and they've been wrong. So just be careful who you're listening to. Watch out for the doom and gloomers. And actually, what I would argue as well is if we put aside the narrative, we put aside the doom and gloom and just look at the data, which I'm going to show you in a second here. I think the S&P is poised to make brand new record all-time highs, maybe after a little bit more of a correction. Not unusual to have a 5%, 10% correction. We're only 2.5% into a correction today. So that could turn into a 5% pullback. You could see stocks at 65, 6,600 points on the S&P. Not that surprising, nothing radically out of the ordinary even with that. But once we get past this volatility, if you look at the commodity level of volatility that's happened and you look at the VIX within commodities, there's actually a great stat that Wisdom Tree put out that says within 12 months on average, the return in the S&P is actually nearly 20% after some of the volatility we're seeing. That's just statistics, data, and math. So I know people like to cling to the narrative, cling to the doom and gloom, and glue themselves to the screen on TV or wherever else or on their phones and just scroll through the doom and gloom. They call it doom scrolling for a reason. And but don't let believe it or not, don't let don't let too much data get in the way of a great narrative. But here at Stenger Family Office, we always want to go back to data. We never want narrative to drive any decision making. We want it to be data. And that's what you should do in the stock market too. So let's talk about some of these past corrections. Here we are today, like I mentioned, February 2026. We're off the all-time high about 2.5%. Actually, if you go back to October of last year, hard to believe, but we already had a 5% correction in October. So these are normal parts of the market. Just put this in context. And that's what I'm trying to do with this slide. February of 2025, that was Liberation Day, 19% correction in the S&P. Then we had March of 2024, there's a 5% correction. July of 23, yes, a 10% correction. December of 21, which continued into most of 2022, a 25% pullback when the Fed started raising interest rates. And then, of course, we remember COVID with in March of 2020, where the S&P was down 32%. It only took 2 weeks, incredibly quick decline. And then September of 2018, the S&P was down 15%. And then May of 2015, the market was down 10%. And April of 2011, we were down 15%. I missed a few of the smaller ones in there along the way. There were 5s and 10s all along the way there too. But these are the big ones that come to mind. And each one of these situations, there was a different set of facts and circumstances. There was a different set of here's the 10 or 15 doom and gloom reasons why the market's down 10 or 15%. And none of those really ended up being true in the long run. So the narrative went that Brexit was going to take us out, that the Fed rate hikes were going to take us out, that COVID was going to take us out. Now the narrative is that tariffs are going to take us out, maybe that AI is going to take us out. There's a narrative every single time one of these happens because the media is not forward looking. They're always backward looking. Important to understand when you see these doom and gloom headlines, you see these stories, the news media is just responding to what happened yesterday. It's always backwards looking. They're never forwards looking. And so what the media is going to do in each one of these circumstances is use whatever the narrative of the day is to explain why we're in one of these corrections. But the reality is for most of these corrections, I'm going to show this to you in the next couple of slides, most of these corrections have actually been driven by money supply, money printing, the Fed. That's the most important factor to watch. If you're going to watch one thing, watch the Fed. Don't pay attention to any of this nonsense with the news narrative. Instead, it's the fundamentals of, number one, don't fight the Fed. And number two, just be aware of how the general economy works, because that's going to drive future outcomes, not backwards looking like the media is, but rather the Fed is going to tell you where things are going in the future. And we'll cover that in just 1 second. All that to say, these corrections are not out of the ordinary. Each one of these, I might add, was also a massive buying opportunity. So if you sat here and watched all these corrections happen and you started rebalancing around these corrections, every single one of them ended up being a buying opportunity, and a significant buying opportunity at that. You could have been buying the S&P at 1,500 points at one point here in this mix. If you could believe that, you could have bought it at 2,000, 3,000, 4,000, 5,000, 6,000. And in each one of those cases, people had reasons why, oh, no, this one's different. I got to stay in cash. What if it gets worse from here? Well, it could always get worse. But again, data math statistics point to the market going higher over the long run. Now, what I'm about to show you is a list of stocks. I do not want you to take this as investment advice. So disclaimer, none of this is investment advice. Don't go do anything based off of what I'm telling you. There's my disclaimer. But here's the data of what's going on behind the surface on an individual level with these companies. Microsoft, one of the biggest companies in the S&P 500, in my opinion, one of the stupidest sell-offs of all time. The Microsoft stock is down 25% when the S&P is only down 2.5%. Absolutely ridiculous. Now, maybe I'm wrong. Maybe it really should be down. Maybe Microsoft should be down 25%. Maybe it should be down 40%. I don't know. I don't have a crystal ball. But what I can tell you is this is a ridiculous sell-off based on forward earnings. And you look at what Microsoft's going to print this year in earnings, what they're expected to print next year for earnings. They're the pipes and wires of the economy, especially for Fortune 500 companies, even small and mid caps. And the forward P on Microsoft is only 24. With one of the fastest growing revenue bases in the country, most stable revenue bases in the country. And you can buy this stock now for a forward valuation of 24. Absolutely incredible. Every single time this has happened, it's been a buying opportunity. Again, not stock advice. Don't go do anything I'm telling you, but I'm just showing you the data. Look at Broadcom and AMD and NVIDIA and Robinhood and Constellation Energy and Netflix and Palantir. Again, I'm not saying every one of these companies is perfect. I'm not saying that they couldn't go down more. I don't know for sure what's going to happen 12 months from today. So just there's your disclaimer again. But when you look at the data and you see a stock down 40, 50, 60%, these are buying opportunities. These are the times where when everybody's running out of the burning building, you run back in and buy some more when times are tough. That's what's going on today, in my opinion. These stocks have shed half of their valuation in a lot of cases. Some of these stocks have gone from 60 multiples to 20 to 18 to 15, yet they have 20, 30, 40% growth rates. Absolutely incredible what's happening. And I'm going to explain why I think this is happening in a second. But let's just look at Microsoft here. Microsoft is down right now. Actually, I had it wrong just a little bit on the last slide, but it's down about 27%. It's changing every day. So right now it's down about 27% in this current correction. But look at July of 2024. Yes, just 2 years ago, less than 2 years ago, Microsoft was down 23%. You could have bought Microsoft in the 300s and then it rallied to $540 a share. Look at July of 23, a 13% correction. November of 21, when the Fed started their rate hiking cycle, a 34% correction, even worse than what we've had today. And hopefully you didn't panic and sell it back then, and hopefully you bought more. February of 2020, look at February 2020, 27% correction. So when we shut down the world, we literally had COVID hit and we said 2 weeks to slow the spread. And then that turned into 2 years to slow the spread. And the global economy was going to look fundamentally different in the future than it did today. Even after all that, Microsoft is down just as bad now as it was during COVID. To me, that's an overreaction. October of 2018, Microsoft was down 18%. Absolutely incredible. Just remember, these corrections happen. This is not a reason to panic. Now, let's keep going. This is why I think some of this is down, at least from a narrative standpoint today. And this is what the media is using to scare everyone. And I did have a client who asked, Nick, can you explain what's happening with software? So here's what's happening with software stocks today. DocuSign, Intuit, Datadog, AppLovin, Oracle, I can't even pronounce this next one, Salesforce, ServiceNow, Adobe. These are softwares that are very user interface focused. So just keep that word in mind, user interface focused, because we're going to go back to that in a second. But these are the software companies where you pay per seat. So if you have a company, and let's say you have 100 employees, and you want to have 100 DocuSign accounts for your employees to send out contracts. I mean, it's not that many, but let's just say it's 100. You're paying per user for DocuSign. Okay, same thing with Adobe, same thing with ServiceNow. All these different software systems, these CRM systems and whatever they might be, are pay per seat. So here's what's really happening, and I did borrow this from David Andre, who's got a great YouTube channel all about software, all about technology. And this is what he describes as the 3 layers of software. So layer number 1 is what you're seeing come out right now with AI. These are called AI agents. These are systems like Claude. Claude is the big one. You're also seeing ChatGPT, Grok, some of these different agents being tailored to various different applications and then being very specifically engineered to do a certain task. And so the reason you didn't see the sell-off when ChatGPT came out and OpenAI and all the rest of it is because those were general tools. Now what we're seeing with Claude and some of these other systems are what is referred to as AI agents, very specific use cases, one of them being a plugin that you can put into Microsoft Excel and do analysis much faster than you used to be able to by yourself just with one person. And so that's where a lot of this value chain is going towards. Number 2 is SaaS user interface. That's that term I threw out before, user interface, UI. That's layer number 2. That's the biggest problem right now. These are the companies who are down is under layer 2. Layer 3 is systems of records. These are databases, ERPs. They tend to be safe from a lot of the problems that we're seeing. And in the short term, it doesn't seem like that because you've got Microsoft down. You've got some of these big names like the hyperscalers like NVIDIA and Amazon are also down. But value long term, if you talk to David, I believe this too, if you look at long term value creation, it's going to be layer 1 and layer 3. Now, what's happening in the short run, like I mentioned, is layer 2 is really the problem spot. Layer 2 are these basically middlemen who put a helpful user interface on top of a database or on top of some sort of useful tool, the pipes and wires. I would call layer 3 pipes and wires. These are proprietary databases. These are systems that are tough to replace. They have their own data. They have to be careful with cybersecurity. But layer 2 is basically an operating mechanism on top of layer 3. And so really these easy to fix software issues like these UI things that Salesforce has done and Adobe has done in all these places, that's what's being threatened by layer 1, which are these new entrants like a Claude. So that's what we have to focus on is how much exposure do we have to layer 2 rather than how much exposure do we have to layer 3. Everything's getting sold off all at once, which is very typical of a declining market like this, where people throw the baby out with the bathwater. They throw everything out. Anything in that tech sector is going to get sold, even though there's these different pieces that make up the total tech sector. So again, if you have layer 3, I think you're much more long-term insulated from some of the problems you're seeing in the short run with layer 2. So now let's talk about, is there an opportunity here with any of these layers, or is it really doom and gloom? Well, with layer 1 being, and I'll go back a slide here. If we go back to layer 1, a lot of these companies aren't even publicly traded. A lot of these companies are privately held, trading at ridiculous multiples. Maybe there's opportunity there long run, but I would equate this to the tech bubble in the 90s. There's definitely a bubble brewing in layer 1 because people are overestimating their use cases in the short run and forgetting that in the long run, technology changes so quickly. Just like if you bought all the best tech stocks in 1999, all these years later now, many of them you aren't even break even on. It's not like they're terrible companies. It's not like they're useful, but you overpaid for their earnings. So a lot of what happens in layer 1, we try to avoid because we don't know what the future holds. We certainly don't want to come in and pay 200-300 times earnings for a stock where we don't know what the future is going to look like. So layer 2 then, from a valuation standpoint, you'd ask the question, is there opportunity? I think this is where you're going to continue to see downward pressure. And long term, these stocks probably will turn out to be good buys. If you go from a 50p down to a 10p, just purely from a valuation standpoint, you probably do have an opportunity. But right now, I think it's like catching a falling knife. It's really problematic to come in here on layer 2, at least at this stage, unless you're absolutely certain for some reason you have a really good investment case that you should still be paying 20 times earnings, 25 times earnings for layer 2. But where the opportunity lies, in my opinion, again, none of this is stock advice. Don't go do any of this on your own or anything like that. Work with a financial advisor. But on layer 3, I think that's where the opportunity is because you've dropped from 35 or 40p ratios down to 20 or 25 on really the pipes and wires. This would be like back in the day, and I'm going to show this to you in just a few slides. If you were to buy energy stocks right when EV vehicles came out, electric vehicles, when EVs came out, it'd be like buying energy stocks that were getting crushed at the time. And people were pretending like all these energy companies were going to go out of business. In fact, the opposite has happened. They're booming. And so you could have bought ExxonMobil and Chevron and some of these companies at 8, 9, 10 multiples, and now they trade at 20 multiples. So you just purely got return off of expansion in multiple. And that's what I think you're going to see in layer 3. So all that to say, I think layer 1 is probably overvalued, but they are very good companies, but they're just highly overvalued. Number 3 is probably the best opportunity. Number 2 is where I say I think that's like catching a falling knife and you have to be a little bit careful. So all that to say, the fundamentals that are going on underneath the surface here is the fact that companies are going to spend $470 billion on enterprise AI this year in 2026. So this is a structural trend. This is a record all-time high, and it's not going anywhere. And by the way, if you have a software company or you have some sort of useful product and you can build up to a $5 or $6 billion ARR, out of this 470 number, you're basically still a very small percentage of the total addressable market. So this is real. There is real spending going on. And then number 2, where are the opportunities? This is what I would put under layer 3, which is the pipes and wires. It's the real companies behind the scenes. And I think it's really 3 things. Number 1, it's AI platform subscription. So potentially, who knows what happens, but maybe Microsoft rolls out a competing product to Claude, and now they can charge an additional monthly fee or pay per use case fee or click fee or something like that on their existing infrastructure. I think that's probably very likely. Number 2 is cybersecurity. And you're already seeing the large tech companies double down on cyber. They're spending more on cyber than ever before because it doesn't matter what happens with AI or not. You cannot cut your cyber budget. So I think that's number 2 opportunity. And then number 3 is consulting. And the consulting firms have really had a tough go at it the past couple of years because people think all of consulting is going to get replaced by AI. I think it's actually probably the opposite. I think it's the people that, and not to beat a dead horse with this terminology, but the people who can use AI that will ultimately reap the most rewards from this tech revolution we're living in today. So I think number 3, the consultants, the service providers, all the people that are around this ecosystem, the picks, the shovels, the pipes and wires of the AI economy are going to be great opportunities in the long run, especially if you can pay the right price for them. So you go back to this idea years ago that everyone's going to be a coder. And you remember this, people are telling their kids, don't go be a truck driver, be a coder. Well, is that really true? Because now with this Claude system, software is falling off a cliff because people are realizing maybe we don't need all these software engineers. Maybe we don't need all these system architects. Maybe we don't need the 10,000 or 20,000 people we used to have doing these jobs. And so this idea that everyone should just quit being a truck driver and go be a coder is just wrong. I mean, that was never the right advice. And number 2, actually what's happening is these structural trends, which are number 1, we don't have enough population growth. We need to do more with less. And that is the idea behind the entire economy in general. Capitalism solves a central problem, which is scarce resources. And so if you have scarce resources, what do you want? You want entrepreneurs creating technology so that we can produce more, we can be more productive with less input. And so that's exactly what AI solves. This is a very good long-term thing. Number 2, like I mentioned, population growth, that leads to less labor supply. And so in the short run, yes, people are feeling it. People who are working in technology are feeling it, especially right now. But I believe, like every other revolution we've had in technology before, on the other side of it is just different, better jobs, but there is a painful rotation period along the way. And so you're going to see this economy continue to go from really what was a manufacturing economy. We're still going to have a lot of manufacturing, but I think you're going to see a lot more services come in too. Financials, healthcare, tech, all these different things that support the AI innovation boom, because people are going to have more time on their hands. They're going to have more time to do things, more money to spend ultimately in the end. And what are they going to spend it on? They're going to probably spend it on services as opposed to just goods. And so that's an important trend in the stock market. And then the last thing is ultimately technology always helps helps people become more productive. And then I also mentioned this, people are going to spend more on luxury and services, and they're just going to have more disposable income. And so whether you believe this happens next year, 5 years, 10 years from now, I think we can all agree 15, 20 years down the line, people will be better off than they are today. And so that's the driving message behind the portfolio and behind the investment philosophy at Stenger Family Office. And then the result of all of this, the end result, is the fact that the trades right now are absolutely booming. And so this idea that everyone should be a coder and not be a truck driver, an electrician, or a plumber is just insane. In fact, I think what's going to happen is you're going to see more and more people go to trade school because the opportunity set's so large, and they're going to be making more money than you could even imagine because there's such a labor shortage still. And you can see these kids who come out of high school, they go to trade school for a few years, they've got no debt, and then they go start a business or go work for an established business, and they're making six figures within a few years with no debt burden. I mean, that's amazing. That's such a good thing for the economy. So that's, I think, long term. These 4 or 5 points are long term the end result of every single tech wave, especially this one. Now, I mentioned ExxonMobil, I mentioned EVs, I mentioned Tesla. I just want to show you what happened between these two different companies since the point of Tesla's IPO. And so if you go back to 2010, when Tesla first IPO'd, roughly about the time they came out with their first mass production car, right in that zone, Tesla now has gone up 24,000% since 2010. That's ridiculous growth because, again, they were starting at basically nothing, going from producing the first car to what it is today. Now, you might have shorted ExxonMobil if you weren't thinking clearly about how the economy really works. And a lot of people did this. They shorted ExxonMobil, meaning they thought Exxon would go out of business while Tesla went up to these brand new all-time highs. That couldn't have been further from the truth. Yes, Tesla did very well, but look at Exxon over the past 15 years, 16 years now, since 2010, ExxonMobil hasn't gone down. In fact, it's produced almost 10% annualized returns, up almost 300% over the same time frame. So it's not that innovation is going to completely displace these existing legacy companies. I think it's the opposite. You're just going to see a difference of where the return comes from, especially if you're dealing with the best innovators within the best companies. Now, here's what's really interesting. That was the 15, 16-year look at it. Look at the 5-year look. And this is Exxon in red and Tesla in blue on the bottom. Just over the past 5 years now, since 2021, Tesla's only up 40% and Exxon's actually up 230%. And why is this? Well, it's because the amount that you paid for Tesla's earnings in 2021 was much more elevated, while the price you paid for Exxon's earnings in 2021 was very depressed. They were out of whack with reality. And so again, just from a pure valuation standpoint, you're going to see some of this rotation continue. The stocks you never thought could get a bid, the stocks you never thought could go back up, will get a bid, in my opinion, just purely off of valuation. And so, yes, we want to look at valuation. It's not the only factor we look at, but if you can get a quality company, which I would argue in 2021, Exxon was working on rebuilding its balance sheet, coming back to normal out of COVID. If you could go back to 2021 and say, hey, I've got a quality energy stock here, this trend where, oil is not going to exist is just ridiculous. And I think I can pay 10 times for Exxon's stock. Well, that worked out. Now Exxon's trading at 21 times earnings, which is probably a little rich. But the point is oil didn't go anywhere. In fact, you've got to use a lot of oil to make a Tesla. So that's the reality of the stock market, the economy. You see this rotation. So if you go back, yes, Tesla's up, that ridiculous amount, while Exxon's up 300%. But you see this sector rotation. I've talked about sector rotation. In fact, the last episode was on sector rotation. This is it playing out in real time right in front of you. So anyways, moving along here, how do you invest, in my opinion, in the pipes and wires economy? I think number one is the wide moat platforms. These are the businesses with heavy capital expenditures that would be hard to replicate. And this would be very similar to buying Exxon in 2021 because Exxon is the pipes and wires of the global economy. Same thing with technology today. and could be wrong on this, but Amazon, Google, Microsoft, just to name a few, even NVIDIA to an extent, are the pipes and wires of the economy. No matter what happens, they have incredible moats. And could that be disrupted eventually? Sure. But they've got incredibly established moat businesses, wide moat businesses that are going to make it tough for new entrants to come in. Yes, you could code a brand new app with Claude, but you're not going to come in with Claude and completely displace Microsoft. That's ridiculous. Number two is energy infrastructure. You're going to need a lot of energy for a long time. And that's why you're seeing all these deals with Constellation Energy and all these different utility stocks finally getting a bid, trading up at 10, 20 times multiples. Why? Because people realize, hey, we can't do the AI economy unless we have a ton of energy. And that's a big piece of the portfolio. And then number three is security. You're going to have to protect your data. We talked about cybersecurity. Number four is technology manufacturing. And I believe it was Arizona. I can't remember exactly, but I think it was Arizona. I was driving along the highway and I looked to the left, massive Taiwan semiconductor plant going in. I believe it's over $100 billion project that's getting built. And that's technology manufacturing. It's the idea that we're investing again in the trades and the actual brick and mortar of the AI economy. And then the last piece is compute speed and power, because yes, AI is a useful tool, but the real thing going on behind AI is compute speed. It's cloud computing, high-speed internet, all the stuff that has to go into it, high-speed computing, quantum computing. Those are all the buzzwords you're going to hear. A lot of it's in its infancy and just getting started, and we'll see what happens over the next 5 or 10 years. But these are the things that you're investing in if you're investing in pipes and wires. And that's always been a very good investment strategy. And then the last thing, and I just kind of threw this in partially as a joke, but who knows if it's true. Elon says, love him or hate him, Elon says we're going to build data centers on Mars. And Jeff Bezos, I guess, agrees with him. And so who knows what happens, but apparently we're going to be building data centers on other planets. So, or on other in other places in space. And so who knows exactly what the future holds, but I would argue over the next 5 or 10 years, these are the common themes you're going to continue to see. So what's really going on? Why do I say what's really going on? Well, yes, what we just covered explains some of the sell-off, but I think really behind the scenes, the driving mechanism of this current sell-off and why we could see a little bit more downward pressure from here in the short run is not really because of this AI bubble concern or not really because of this concern directly with Claude or anything else. It's really because of interest rates. It's because of the Fed. And I want to go back to something I said at the beginning of the show, which is don't fight the Fed. Don't try and fight them on the way up with interest rates. Don't fight them on the way down. When the Fed moves interest rates, or at least expectations of what the Fed's going to do changes, it sends the long end of the yield curve either up or down. So remember the way the Fed works, they only set that front end of the yield curve. They only set the overnight lending rate, basically. And then everything else with fixed income markets trades the 2-year, the 5-year, the 10-year, the 20, the 30-year treasury, all traded by markets. And so even though the Fed's cutting interest rates like they basically have been for the past year, you're seeing longer term yields. This is a 10-year treasury actually rise a little bit. Why is that? Well, it's probably the market's assumption that we're going to have a more normalized economy going forward than we've had the past couple of years. The yield curve inverted in the past, in 22 and 23 and a little bit of 24. Why? Because people thought that the Fed was going to be forced to cut rates, which was a sign of problems to come, which was a sign of a recession. And so when the yield curve inverts, it's not always right, but when the yield curve inverts, it's people's expectation that we're about to go into recession. Right now, we're actually starting to see the yield curve normalize a little bit, where the 10-year's up a little bit, the 30-day treasury's going down a little bit. And so we're actually entering more normalized interest rate environments, which is not a bad long-term sign. It would be a bigger problem if the Fed had to start really cutting interest rates. Why? Because that's a sign of bad things happening. Mortgage rates, for example, are priced usually on a 10-year treasury. You're seeing mortgage rates start to come down. And the peak for a lot of people were about 7%. I have some clients who got locked in at 6.8, 6.9% of their mortgage. All of these mortgage rates now are coming back down to reality, closer to 6%. I think you're going to start seeing 5.5%. You might see 5 and 7-year ARMs come out at 5%. Why? Because bankers, the economy, traders, they're actually pricing in growth over the next 12, 18, 24 months, not doom and gloom. So in the short run, when these yields change, yeah, it sends valuations down. That's a normal piece of what happens. That's why the market was down in 2022, is because we had this inverted yield curve and rates on the long end were problematic, and people didn't know what was going to happen. Well, now we're in a same kind of zone where the 10-year Treasury is rising a little bit. Why? Well, here's what it is. Number one, Trump is nominating Kevin Warsh to be his Fed replacement pick, and Kevin is a little bit less dovish than what people expected. He's actually, it looks like he's going to keep interest rates basically at status quo, maybe go down a little bit, but he's not this big time person on cutting rates. There were a couple Fed chairs like Kevin Hassett who said, well, we're going to cut rates quickly and we're going to get the economy booming again and all this stuff. Well, Kevin Warsh is just not the same. And so he's coming in and saying, well, we're going to do a little bit higher for longer. That's partly why you're seeing a valuation reset. Number two is that higher for longer idea. And then number three is, so far, we've avoided recession. So if we keep avoiding recession, why should the Fed come down quickly? Now, I do think the Fed is a little high, probably 0.5% too high or something like that. But regardless, why should the Fed go back to 0% interest rates if you're still seeing growth of GDP and growth in earnings? That's why you're seeing that long end of the yield curve normalize, because people think for the most part we're going to avoid recession. We'll see. I don't usually make calls on recession or not recession. I've argued that I don't think we're going to go into recession anytime soon, but this is what the rest of the market is telling you as well when you see that yield curve normalize. In fact, the bond markets tend to be more accurate over the long run than the stock market is, even at predicting recession. And then the last piece of this is that you're just simply having what I think is a valuation reset, which is a healthy component of a bull market. You're not supposed to go up in a straight line forever. In fact, if the Fed cut rates to zero and then you saw all these stocks go back to 50, 60, 70 Ps overnight, that would be a much more concerning problem than what we're seeing today, which is a healthy sell-off to get valuations back to normal. That's a good sign. So don't be alarmed by these pullbacks. Don't be surprised by these pullbacks. This is a good thing in the stock market. If we were just going up 10% every single day with no corrections, that's the late 90s. This is not that. This is not the late 90s. And again, you see some of the valuations on these big tech stocks, they're right in line with historical averages now. So that's what's happening behind the scenes. The fundamentals are still strong, and I'm going to leave this with you pretty much as my closing slide today. And it's the fact that, number one, the long-term structural bull market, in my opinion, is still intact. It's the three prongs, the boomers, the zoomers, and the growth in the emerging markets that are driving the stock market over the long run to new highs. It doesn't matter what happens in the short run with geopolitics or anything else, or interest rates or anything, quite frankly. This long-term structural bull market is still going to continue. That's number one. Number two is earnings are at record highs today. The fundamentals are still very good of the market and these big stocks, and their earnings expectations are going up. And so remember how management teams do things. They try to be conservative. If they tell you we're going to go up 10% in earnings over the next 12 months, they usually aren't telling you their most aggressive estimate because they don't want to be wrong and get punished in the stock market later. So earnings estimates are actually coming out still about 12, 15% higher than they were at the beginning of the year. That's a positive sign for markets. The next thing is that innovation is a normal process. Wealth creation, and I put that in bold, is not wealth creation, not wealth destruction, is always the end result. It's never the opposite. It's never that we have more innovation and then people's wealth goes down. It's that we have more and more innovation and long-term wealth creation goes up. That's why U.S. household net worth is at the highest point it's ever been in history, even after inflation, even after money printing, even after all the headwinds we faced, after all the doom and gloom events, U.S. net worth is higher. Why? Because innovation is the fastest it's ever been. It's exciting to watch. So here's just a couple quotes I'd like to leave you with as well. And this is straight from Warren Buffett. Be greedy when others are fearful. That's what we want to do. When everybody's scared, that's the time where opportunity lies in the market, and that's the time to be buying. Number two, you make most of your money in a bull market This is the a bear market. This is Shelby Davis. And Shelby Davis said you make most of your money in a bear market. You just don't realize it at the time. This is the time where you should be buying. And then number 3, this goes way back. I think this was in the 16 or 1700s. Buy when there's blood in the streets. Even if it's your own blood, there is blood in the streets right now. And then the last one, bears sound smart, but bulls make you money. So yes, the bears who come out of the woodwork each and every time that we have one of these corrections or declines or short-term moves in the market, every single time these bears sound smart on CNBC and Fox Business. But in the end, it's the bulls who have made you money. So I would encourage you, again, stay on your plan. If you've got cash, now's the time to be looking at opportunities. We can help you deploy some cash. We did a rebalance at Stenger Family Office earlier this week, and we'll see. Maybe our timing was slightly off. It's going to be okay in the long run. I believe the fundamentals of the stock market and these companies, the fundamental reality of this long-term bull market is still on track. So don't go anywhere. Don't jump off your plan. Don't panic. And now is the time to be buying when everybody else is fearful. Thank you so much for being on for this week's episode. We'll see you next time.